I'm just like taking this webinar live on our YouTube also.
Okay.
Just, yeah. Few people will join in there as well. Also, awesome. We are live, Alok sir, on YouTube.
All right.
As well.
All right. Great.
Firstly, a huge thanks to all the attendees who have like came in here with on a Tuesday evening. I'm very glad that Alok sir's like momentum investing series, which we have planned out, it's turning out really well. Just a small brief about myself. I am Rahul and I'm part of the growth team at Dhan. And we are also hosting the second series of momentum investing by Alok Jain sir. Alok Jain sir actually requires no introduction, but just the people who have actually joined in for the first time. Alok sir is a graduate from the Indian Institute of Technology, Delhi, and holds a master's in finance and an MBA from University of Maryland, USA. He has been in the Indian stock market since 1996, the year I was born, actually. Alok is passionate about building rule-based investing model portfolios to generate superior returns with lesser efforts. And we also know that Alok sir is like one of the most renowned experts for momentum investing. So over to you, Alok sir.
Thank you, Rahul, for the nice introduction, and good evening to all the participants of this webinar. And I hope that all of you have seen the first part of the series of this momentum investing seminar, because we are leading from the first part into the second part. So in case you haven't, maybe you can go back and see the first part also, because a lot of things you will be able to correlate, which have been discussed already in the first part. And so we will start the next one. So essentially, let me first also share my screen. Rahul, is my screen visible?
Yes, Alok sir, it is.
Okay, thank you. So as I was mentioning, part one is something that you want to see, because part one is where we discussed what is momentum, how we measure it. So, various ways of measuring momentum, then different types of momentum strategies that you could build. We also discussed about momentum versus in other investing styles. So, you could look at various factor-based investing styles, and momentum is one of them, but momentum seemingly is one of the best ones there. There have been a lot of research and research papers published in the US for mostly for last 150 to 100 years of data there. And they found that momentum factor investing has beaten all other formats of investing. And then we also discussed some weekend investing strategies and their performances in the previous session. So if you have not seen the previous session, I would suggest please go and see the previous session. Now, in today's session, what we will do is we will go through a construction of a simple momentum strategy. We will go through some rules of the strategy, how you can frame the rules of a strategy. We will go through the backtest performance of this strategy that we are proposing. We will also go through winners and losers from this strategy. And we will bust some momentum investing myths at the end of it all. So for most of you who have seen the first part, this would be a very natural progression. But for those who haven't, momentum is a style of investing where we allow stocks that are moving up, for instance, to so the price and the volume behavior of a stock to dictate what needs to be bought and what needs to be sold. So in a very simplistic manner, I can say in this particular style of investing, we buy what is going up and we sell what is going down. And there is no emotion attached to any stock. There is no marriage to any stock. As long as it is fulfilling the requirement of a buying buying criteria, we will buy that stock. If the stock is fulfilling the criteria for exit, we will exit that stock. And there is essentially no discretion involved in all this process. So it is not that one fine day I will, if I like a stock because of XYZ narrative or a story, etc., then I'll buy that. It is not like that. It is a completely rule-based system. So if you formulate all the rules, then you can essentially just follow the rules in a very simplistic manner. And to that extent that you may find that it is too simple. And most people who go through these uh, rules and create their strategies first don't believe that such simple rules or strategies can really make money. But once somebody goes through these processes for a few years, they realize that the magic is in the simplicity of the system. And unnecessarily people are complicating a lot of things which need not generate a very superior return for them. So just to brush up on the types of momentum part, because this is important. So three different types of momentum is something that we can discuss. One is called a relative momentum or a cross-sectional momentum. Here, what is happening is that, let's say you have a portfolio of 20 stocks. So you are essentially bringing the stocks into your portfolio based on a relative basis. So if you have a list of, let's say, 500 stocks and you have to pick 20 of them, then those 20 some quality which is relatively better than the rest 480. That quality could be based on different parameters, but it is essentially doing a relative analysis of one stock versus the rest of the pack. So that is essentially relative momentum. So even if all stocks are down, let's say the entire CNX 500 index, let's say down 10, 20, 30%, no stock is in the positive for the last 12 months of, let's say, the price change. Even there, you will find that relatively, there will be some stocks which have done better than the rest of them. And that relative outperformance is what will cause them to stand out and get selected into your portfolio. So anything which is allowing you to do a relative differentiation from the rest of the stocks, you will term it as relative momentum. Now, absolute momentum is something, or time series momentum also it is called, or trend following, is a basis where you are essentially looking at each stock individually without relation to all the other stocks around it. And on its absolute basis, you are in a way ranking or judging that stock. So for instance, my criteria is that, I'll let go of a stock, or an exit rule could be that, if a stock drops below, let's say 50-day moving average, I will exit the stock. Let's say this is a rule in my strategy. Then we are measuring 50-day moving average for each stock in the portfolio. And as soon as that 50-day moving average gets breached, we are exiting that stock, regardless of what other stocks are doing. So we are exiting this and going to cash. And if a buy rule gets fulfilled, then only we are buying a stock. So in relative momentum, if the portfolio was, let's say, 25 stocks, it will always remain 25 stocks, because relatively that parameter will always get satisfied. If we are saying the strongest 20 stocks out of 500 based on 12 months of price change, then that strongest 20 will always remain, whether they are absolutely negative or in positive. In absolute momentum, however, you may have situations where the entire portfolio may go to cash because you are not getting any absolute matching of the parameters that you want. Let's say your absolute momentum ranking condition for a buy condition is that the stock should be above 200-day moving average. Only then you will buy it. So now let's assume that you are in October 2008 and all stocks have crashed by 40, 50, 60, 70%. And there is no stock which is in that particular cohort of, let's say, Nifty or CNX 200 or whatever is you may be looking at. There is no stock above 200 DMA. So your buy condition cannot be satisfied by any of the stocks. So you will not be able to, have any constituents in your portfolio for now until those stocks recover and they satisfy that condition at some point of time. So you would sit in cash till then. So that is the sort of quality of absolute momentum, that it can go to cash, and it works basically on individual stocks displaying absolute parameters without relation to each other. Whereas in relative momentum, you have relationships or relativity versus each other. And dual momentum, I'll not go very deep into it, but it was a sort of a subset of both these put together in context of how to trade and invest into ETFs, etc. So that we will sort of not get deeper into. But these are the two major ones that we have always looked at and discussed. Now let's start to build a very, very simple strategy. Now, this strategy, of course, the backtest result will be there with some assumptions, but you can always build more rules on top of it to make it more robust. I'm keeping it very, very simple so that you get the very basic idea of how simple all this is. So let's assume we have a universe of CNX 500 stocks. So we have 500 stocks. These 500 stocks are the top 500 market cap stocks in the National Stock Exchange. They are mostly all very liquid. There would likely be no stocks which will give you any surprise that these are any fraudulent stocks or things of that kind. So you're not going into that segment of the market at all. You are essentially looking at reasonably good quality stocks. Now, our rule here in this particular strategy is to have a 20 stock portfolio. So we want to have 20 stocks in our portfolio, and we want to do a relative momentum strategy here so that we have 20 stocks at all times, and we want to pick the strongest stocks from CNX 500. So now, what does strongest stocks mean? It could mean anything. It could mean stocks which have the highest 14-day RSI. It could mean that they may have the highest 12-month price change. It may mean that you have the combination of few indicators contributing towards that ranking, which may be the highest. But for simplicity's sake, we are saying any stock which is hitting 52 weeks high out of these 500 stocks, it can be our candidate for this portfolio. So any stock that is 52 weeks high becomes a candidate for the portfolio, and you are allocating 5% to each stock because you are having 20 stocks in your portfolio. You can essentially contribute 5% to each of the stocks in your portfolio here. Now, there could be a case where you may get, let's say today, if you want to see how many stocks hit 52-week high out of CNX 500. Let's say today was our starting day, and we want to pick stocks for this strategy. So let's say we've picked 20 stocks, but when we do our screening, so you could use some software like screener.com or tradingview.com to select such stocks. Many facilities are available on many platforms where you could do sorting of RSI, or you could figure out which are the 52-week high stocks, etc. So let's say you got a list of 52-week high stocks, and let's say we got 30 stocks. All have hit 52-week high today, all from the CNX 500 universe. Now we only had to choose 20. So now we need another rule, how to choose 20 out of these 30 stocks. So let's say we decide that we will choose the RSI indicator as a uh, measure of ranking for how to select 20 out of these 30 stocks. So all these 30 stocks we have listed, which are all hitting 52-week highs. And now we will also list their RSIs, let's say a 14-day RSI in front of that, and then sort it so that we have the top 20 stocks with the highest RSI, which have also gone above 52 weeks high today. So this is your the way you are sampling your constituents of your strategy. So you took 500 stocks, you looked at stocks which are 52-week high. If you get more than 20 stocks, you would choose another indicator, like for instance the highest RSI, to get 20 stocks. Now this was entirely your buy rule. So I mean, you've bought this today with 20 stocks and 5% allocation to each, and now every week you will look at this this portfolio and recalculate the exit strategy. So the exits, what is the exit rule? The exit rule is that we calculate the average price of 52 weeks high and 52 weeks low for each of these stocks. So you have 20 stocks, you write in front of them it's 52-week high and it's 52-week low, and the average of the two. So if 52-week high is 100 and the 52-week low is 20, then the average of that is at 60, right? 100 plus 20 divided by 2, average is at 60. So you are writing, 60 is your exit criteria for this stock for this week. So you have exit criteria of these 20 stocks for this week, right? Now, let's say you have, let me just see what is my analysis here. Okay. So now you're doing this exercise on a weekly basis. So in the next week, once you bought these 20 stocks, then after 1 week, you are looking at all the exit criteria. Has your stock breached any of the exit prices? So if, let's say, 2 stocks have breached the exit price, then you will exit those stocks, and then again look at which are the stocks which have gone above 52-week high this week, and bring those stocks into your portfolio, replacing the 2 that have gone out. Or in case there are no new 52-week high stocks in that week, you will sit in cash. So this is, I'm sorry, absolute. It's an absolute momentum strategy, not a relative momentum strategy, which I wrongly said. But this is an absolute momentum strategy where you can go to cash if the system so goes through. So what are you doing? You are just spending 5 minutes a week in finding whether your existing portfolio has any stock which has breached the exit rule. So average price of 52-week high and 52-week low, has it been breached? If it has been breached, it has to be exited. The cash that you've generated from there, you have to redeploy it back. To redeploy it back, you're looking at stocks which are hitting 52-week high. If there are stocks which have hit 52-week high, you will bring them into your portfolio and allocate that cash to them. If you don't have any 52-week high stocks anymore in that week, you will sit in cash till you get the next set of 52-week high stocks. So there will be situations where if the market is just going down, gradually you will exit out of all your holdings because they will start to breach this average of 52-week high and low. But no stock is hitting 52-week high because the entire market is coming down, and hence you will be sitting in cash. Once the market starts to bottom and starts to go up, there will be some stocks which will hit 52-week high first. You will start to get into those. So you will automatically would have churned your portfolio into the leading sectors of the market, because those are the ones which will hit 52-week highs first. And you would not be sitting on laggards. So you would have exited your portfolio as the market is coming down, and as the market starts to build back up from a deep recess, you would get into the fastest moving stocks first, and that's how you will repopulate your strategy. So I hope you are following this. In case I'll have a Q&A session at the end of it, so don't worry. If there's any doubts about how we are doing this, I can clarify it later on. The assumption we are making here is that we are assuming 0.15% as the cost per trade, which is as per standard zero brokerage kind of brokers. Another assumption is that there is no slippage at the end of the day. So if you are, if I've taken Friday's close price as an exit price or a entry price, I'm assuming that I'll be able to buy or sell at that price. And I've chosen the current CNX 500, so which changes every 6 months by a little bit. So in the last few years, some stocks would have not been there, which are there today. So some survivorship bias error would have been there in the results that I'm showing you. This is just for the purpose of displaying what kind of performance you can generate from such simple strategies. So just for sake of simplicity, as well as to reduce the survivorship bias error, I have not gone too far back. I've just taken data from January 2020. So before COVID. So I have assumed that you created the portfolio in January 2020, and then you had the COVID fall, and then the COVID recovery happened, and then you till March 2023 you had this portfolio for 3 years and 1 quarter. So you had 13 quarters of data in here. Now the assumption here was that we started with initial capital of 10 lakhs. You could start with lower amounts also, but you have to just make sure that if any stock that you're choosing, let's say you start with 1 lakh, for instance, then you will only have 5,000 rupees to allocate to each of those 20 stocks. And suppose you get a stock which is like Bajaj Finserv, or some other stock which is 7,000 rupees like Tata Elxsi or something like that, then you'll not be able to allocate 5% to that. So my suggestion would be that you choose at least 2 lakh rupees as a minimum in initial capital, or you can redesign the strategy in such a way that you have maybe like 10 stocks and not 20, but that will become a bit concentrated. So when you run this very, very simple strategy, you will find that your initial capital of 10 lakhs would have become 23.94 lakhs over this period of 3 years and 1 quarter, which is a net profit of 13.94 lakhs or 139% gain. Annualized return over this period is 30%. Risk adjusted return is 33%. Total transaction cost is 18,000 rupees. Maximum system drawdown. So the maximum drawdown you had at any point of time was 23.9%. So you did not lose more than 23.9% of the maximum that you had achieved in this journey of 3 years and 1 quarter. This is how the equity curve would have looked like. So the CNX 500 index is this dotted line. So you started at 0 in January 2020, you went to minus 29% on CNX 500, then there was a recovery. And after that, from October 21, it virtually went flat. And CNX 500 gave you a return of 51.5% over 3 years and 1 quarter. Whereas this strategy started at 0, it went down to about 18.9%. Then from there, it recovered very rapidly. And you can see that the widening gap between these two was there till about July 2021. And then after that, it went flat for some time, but it started to gain again while the index remained flat, because your strategy has stocks that are hitting 52-week highs or going with rapid high momentum, and hence it is beating the underlying market. So this strategy has done 140% versus 51% on the underlying index. So huge outperformance over the period of about 3 odd years. Now let's look at what happened inside. So this was the biggest gainers and losers in this period for the strategy. So alkylamine, this was bought in January 2020 at 465, and you allowed it to run till the exit criteria was met at 3103 in Feb 2022. Mind you, even though you started at 465, it probably went till about 4,000, and then it started to come down, and then the average 52-week high-low was met, the criteria, exit criteria, but still you made 566% on this particular transaction. Dixon also, you entered in January 2022 with 436%. Laurus Labs 99 to 452, Deepak Nitrite 532 to 2000, Aarti Drugs, Bsoft, Apar Industries. These are the top gainers. And you can see all the top gainers are in hundreds of percent because you are allowing the stocks to run as much as it wants, and you have a clear-cut exit policy. And the biggest losers, 36%, Awas minus 36%, BCG minus 35%, Sharda Crop, NMDC, Jindal Steel, Wellcorp. So you can see that all these stocks, these are significant losses, 25 to 35%. But compared to the biggest gainers, these losses are very, very small. So the idea is that you will have plenty of losses, but those losses will be much, much smaller than your big gains. So you will have maybe 50% of your transactions going into loss, 50% of your transaction going into profit, but the average 50% loss will be much smaller than the average 50% gain. So that when you all put it all together, the maths will work in your favor. So this is the stock-wise performance here. You can see that these were the top few trades, 500%, 400%, 300%, so on and so forth. But there were huge number of other winners which were 100%, 60, 50, 40, 30s, and so on and so forth. And some trades which were in loss here, as well as on the next screen, we will have other losses. So a lot of losses of 10%, 15%, 20%, 30%. The number of losses are much more than the number of wins, but the wins are larger, and the average win actually creates that difference where 20% of your winners will actually make the whole difference to the strategy. So just like, Pareto's rule, you must have heard of, 80-20 rule applies in every facet of life. Here also, 20% of the winners will be, will do enough gains to take care of the rest 80% of your transactions that you do. So now let's also go through some charts, how and where, stocks entered. So alkylamine entered here. Notice that it entered here, but there was a crash from 710 to 450. But because our exit rule was not met, we were not bothered. And then it kept going up. We were just fine in letting it go up. It went to 4,800, but exited at 3,100. So we lost some ground here, but that's okay because, we have made a significant amount on the way up also. Another one was Dixon. So we bought here. Again, you can see in COVID crash, it went from 830 to 595, but then it rose from 595 to 6,000, and we exited at 4,493. So we lost a good 20-25% from the top, but we made 436%. When you have rules, you will not be bothered if, you are not feeling so good about the stock when it is falling, or you're not feeling FOMO if some stock is running, because you have to buy by the rule and you have to sell by the rule. So you don't want to be, tinkering around with your rules, and you will not allow your, very bubbly kind of your thought process to, jump at every stock that is jumping up, or get out of every stock that looks like falling. all that actually creates the damage to the portfolio, which otherwise is not required. So here, for instance, Loris Lab, you can see entered at 99, sat through it. Once it starts to fall, it has satisfied your criteria. You exited at 452, then it comes down to 303, so on and so forth. So what is also happening is that because you are exiting stocks that are not performing anymore, you are freeing up your capital and not losing opportunity cost on that capital. So, for instance, if you are allowed this to carry on in the hope that Loris Lab will someday come back up, and maybe it will someday, but why should I waste my capital for 1.5 years sitting in this stock and also losing capital here, where I can utilize the same capital on another stock which is satisfying my entry criteria and which may likely give me more benefits. Similarly, not every trade will become a winner, or there may be trades which will give you a loss but then go up later on. So Adani Green, for instance, in this strategy was entered here 193, but in the COVID crash it got exited, and then Adani Green went, to wherever it went. So it was an opportunity loss. But if you are playing by the rule, I mean, so what? Another one was Avas, where you entered at 2000, but in the COVID crash, you had to exit at 1310. It went further down to 800, and then it recovered later to 3000, but again it came back to 1400. Another example was Sharda Crop, where you almost bought it at the top. The stock did not go any much further up, and on the way down you exited at 482, but it also came down to 370 after that, and you utilized your capital elsewhere since then. So what you have seen is that let me just go back to the results. So what you've seen is a very, very simple rule-based system has been able to give you a annualized return which may beat most of the strategies out there. Most managers will not be able to get this kind of return. But this strategy, which may require maybe 5, 10, 15 minutes of your time, has performed in a way where, it is unimaginable. And this is what is the beauty of it, is that often we feel that, things that are, looking to be extremely simple may not work. But my experience with momentum investing, and we've been doing it for, I think, more than a decade now. And a lot of clients have been associated with us since 2016. So 7 years of serving, several thousands of clients. Our experience is that whoever can discipline their minds in cutting out the noise from the rest of the, not looking at any narrative beyond your rules and just following your rules, you will be able to beat the market more often than not. So this is very, very important, that you create your rules which satisfy or which are in line with your psychology and your risk-taking ability. And then you just play it along, and over a period of time, you will come to a situation where you may gradually improve your rules, and gradually you may find that, you were unnecessarily bothering about so many 50,000 variables in the market, where simple rules were able to beat the returns of complicated strategies, and it gives you complete peace of mind. So, you are spending 15 minutes a week and you are reasonably assured that if something really goes bad in the market, the strategy will get you out. So, market starts to fall, you go to cash, you've exited. Yes, you will probably lose some money while exiting because you've seen the top, but at least when the market starts to build up again, you will have the right stocks in your strategy at that time, which will be the leading stocks of that next move. As you would have always heard that in every new bull run, new set of stocks lead the rally. So usually it is very late, once the rally has peaked or is near its high, people figure out, oh, okay, these were the stocks that should have been bought. But when you are using a rule-based strategy, you don't have to do that. So I'll just end the conversation, this webinar presentation here with the busting of some myths on momentum, and then we will go to some Q&A if you like. So the first myth about momentum investing is that it is like short-term trading. It is not investing. So the fact here is that we have an average hold period of 3 to 6 months, at least the way in which weekend investing runs its momentum strategies. And just like fundamental investing, momentum investing can be done in 10,000 different ways. The way you want to design your strategy, the way you want to keep the frequency of your rebalance. Some people may do it on a monthly basis, some may do it on a quarterly basis, some may do on a weekly basis, some may do on a daily basis. So, but on our most of our strategies, which are weekly and monthly, we have an average hold of 3 to 6 months. And sometimes we hold the stocks for years also if they continue the momentum. The next myth is that it's an edge that will go away if more people do it. So as I was mentioning earlier also, there have been empirical studies for 200 years of data in the US markets, and momentum remains the best performing factor investing style. So what I would like to add here is that because it is contra-intuitive, you are the normal way of investing is buy low and sell high, whereas here what we're doing is we are buying high and selling higher. So it's contra-intuitive. You don't feel like buying when a stock is at 52-week high. You want to sell at that point. But that is exactly why there is a alpha that gets generated here, because the mass psychology is most people would sell out whenever they made 20, 30, 40% on their investment, or if a stock has hit a 52-week high, whereas professional traders would allow a strong stock to follow the trend. And the last myth, and it is not really just a myth, it is a refrain that comes around very often when people look at momentum, is that it is too simple. How can it give results? So the fact here is that it is simple, but it is not easy. Why I'm saying that is because, as I mentioned, it is contra-intuitive. So it's very simple to say that, for good health, just go out every day, every morning, 60 minutes of jog or a walk or something, and you'll be, having a great health results. But how many are able to do it in a disciplined way on a regular basis? So essentially it is simple, but it is not easy. But what we have learned over the last decade is that if you are able to discipline your mind, if you're able to cut out the narrative and the noise, and you follow simple rules, whether these or different ones, you will be able to get that particular alpha out of the market. So this is something that you can use for weekend investing products if you like. WKI Dhan 20 is a code that you could use here for weekend investing strategies, and I'll turn it over to Rahul for Q&A session if there are any questions.
Yeah. Awesome. 1 second, Alexa. Hello. Yeah. Awesome. Very insightful, Alok sir. The webinar was like, I was also actually very passive, actively listening and writing down the notes for myself. So we do have few questions actually.
Okay.
That will be in the interest of all the investors also, and like few have been asked by the our participants as well.
Sure.
We have a question by Arvind Patel on our YouTube channel. So he's asking, there are like few. I'm clubbing his number of questions here. So firstly, I investor like me also, actually I struggle with having a lot of deciding the number of stocks I would like to have in my portfolio. So the question is actually by Arvind also in the same way. What should be the ideal number of stocks in one portfolio, and how should we decide the allocation percentage for large cap, mid cap, and small cap in our portfolio basically?
So I would say that I mean, again, there is no holy grail around this. There are investors who will not go beyond 5 or 10 stocks. Those who feel that they have a good grip on how to choose the stocks or how to change or exit the stocks. But in general, I've seen this 15, 20, 25 is a sweet spot where you can have maybe 4 to 6% allocation to each stock. As you go deeper into the mid cap and small cap territory, I believe that you should increase the number of stocks because the risk element is going up on a per stock basis. So, for instance, some of the small cap strategies that we have 35 and 50 stocks also. So, what we have discovered is that because small caps and nano caps also have a higher risk profile, and there is propensity for any stock to just drop dead. You want to limit your exposure there, so that even if you are having 2-3% exposure to one stock, and let's say every year one stock goes for a toss, you are still saved in terms of not having concentrated exposure to that. But having said that, there are enough uh, people who also promote very concentrated portfolio creation. But those are, I would think, very, very professional oriented investors or traders who can take those kind of risks. For mostly retail investors, I would suggest this ballpark figure of 15 to 25.
Okay, okay. Thanks, Alok sir. So apart from the screeners part also, Alok sir, so what are the other like, is there any particular indicators or something that is associated with momentum investing that you would like suggest for our users?
So you actually don't need any indicator. You can just look at price behavior. So if you are looking at, let's say, the rate of change of price over a period, that itself can be the basis of your ranking. So if you are looking at today's price versus 12 months ago price, and you rank your index stocks based on that, that itself is telling you which stocks have been strong in this last 1 year, which stocks have been weak, and how they're going to churn over a period of time. So price itself can be your best friend. To add more flavor to your ranking, and to have more parameters in your entry or exit criteria, you can add some indicators. You can use some averages, you can use some average true range, you can use some 200 DMA, you can use some RSIs, you can use absolute percentage drops. You may have a rule that if a stock drops more than 20%, I'll get out of it. That may be a rule. So anything can be a rule. The main thing is that whatever set of parameters you choose, first of all, you should it should sound logical to you, that these rules will work. And then, of course, you must rigorously backtest them as to, if you were present in the last 10 years of data, then what would you have achieved with those rules. And although the past performance is no guarantee for the future, but it does give you confidence that the market's nature don't change overnight, especially for longer spans of periods. You're not talking about 5 minutes or 10 minutes, you're talking about weeks and months. So weeks and months, the market doesn't change from one decade to the other. So if the rules have worked in the past, they're likely that they will work in the future. So simple rules can be created or drafted for running these strategies.
Awesome. Thanks. We have like one last question actually.
Yeah.
But here it's little controversial per se, if that's the right word. But like a lot of people actually associate the momentum investing is actually little bit related to market timing. Yeah, or they try to time the markets and then invest and everything. What's your take on that? Like, how does market timing, does it play a role in momentum investment?
See, it's absolutely right that momentum investing is trying to come in at the right time and exit at the right time.
Right.
So from that perspective, it is a timing game.
Right.
But what we are talking about is timing based on rules. Whereas the usual timing issue that we come across in any discussion is about whether we are able to time it or not. Here, what we are saying is we have laid down some rules, and those rules themselves will be able to, time the market in terms of entry and exit. So from that perspective, it is a very different kind of, a non-discretionary way of trying to get in and get out of the market. So the conventional method, every day you're trying to figure out whether to get in, whether to not get in. You're trying to time it in that, so to speak. Here you have set your rules for once, and then yes, the rules may enter or exit at some point, but I mean, your mind is not trying to time it at that from that perspective.
Understood. Awesome. So, Alok sir, no more questions from our end, from the users end also.
Sure.
Once again, thanks a lot for joining in on this Tuesday.
Thank you.
Yeah,
Thank
and
you.
lots of thanks to all the participants also who took out their precious time to join us. Before
Thank you, everybody.
before moving on, like firstly, you can invest in all the weekend investing small cases directly through the Dhan app. We are
Yes.
also running a small promotional code for you to directly explore the weekend investing small cases. It's VIWIK Dhan 20. It's a 20% off on all the weekend investing small cases. So do grab it and explore all the small cases and on Dhan as well. Thanks, Alok sir. Thanks a lot once again.
Sure.
Looking forward to the next set of sessions as well.
Thank you.